There's an old expression on Wall Street: the stock market takes the stairs up and the elevator down. What's going on with the markets? We're going to try to answer that question. We're going to look at the economic calendar. We had a lot of news this week. We're going to look at the Fed projections. They have changed. The futures market, they've changed too. And we're going to look at the stock market internals. There's something you may not expect to see. Well, the S&P 500 in February was very weak. We dropped down about 10%, hitting lows in the month of February. Bouncing back up, that gave us reason for hope. But that hope has all since disappeared, especially as of this past Friday. Markets were very weak indeed. Let's look at the economic calendar. Durable goods started off last week. That was good news, but good news may not be so good. Here's durable goods on a year-over-year basis, rising 3.4%. That's good. That's the second highest number we've seen in a while. The durable goods represent the sales of appliances, aircrafts, machinery, automobiles, those things meant to last more than 3 to 5 years, considered to be a staple of the economy. But, well, within the good news, not so good news. Orders for long-lasting U.S. manufactured goods unexpectedly rose in February as businesses rushed to place orders for primary metals and fabricated metal products ahead of the tariffs. We're seeing this in some of the numbers. There's increased commerce. There's an uptick in purchases, but not because the economy is getting better. People and businesses are rushing to the stores before these perceived tariffs. There's also mixed messages from the housing markets. New home sales on a year-over-year basis, that was up 5.1%, better than last month, but we're seeing an overall trend to the downside. The volume of homes is declining, the volume of homes sold. However, Case-Shiller Home Price Index year-over-year, 4.1%. That's the best number in the last 5 months. So prices are rising. It's just the volume of sales is declining. Also, new home sales monthly supply, that's at 8.9 months, meaning it would take 8.9 months to sell off all the inventory that we have at the current pace. But 8.9 months is a high number. That's a lot of an inventory. We want to see this number near 5 or 6. 9's a high number. The Fed was right, by the way. What do we mean by that? Growth is down, inflation is up. Remember their last projections as a result of the last Fed meeting? They indicated that their growth estimates have now been pulled down and they're leaving the room for higher inflation. Neither one of those is good news, by the way. Well, GDP was released on a quarterly basis, 2.4%. That's the worst number in the last 3 quarters. Also, PCE, personal consumption expenditure, that's inflation, 2.5% on a year-over-year basis. More concerning, core PCE, excluding food and energy, fuel's been weak, by the way. Taking that out, 2.8%. That's the second highest number we've seen in the last, well, quite a long time, actually. So the Fed was right. Looks like growth is slowing and inflation is ticking higher. Also, the first quarter is on track for negative GDP. That's by the Atlanta Fed. They said, based on their GDP Now tracker, incoming data is indicating that gross domestic product is on pace to shrink by 1.5% for the first quarter. Perhaps the biggest economic news this week was not that. It's this. Consumer sentiment falls to the lowest level in over 2 years as worries about the labor market grow. The final reading of consumer sentiment in March fell to a 32-month low as more Americans than at any time since the financial crisis think unemployment will rise in the year ahead. We're going to talk more about employment. We have reason for concern. Now, how bad are the markets? That's the S&P 500. Very weak month in February. March 13th lows, 55.05. We recovered, but as of Friday's close, 55.72. We're just a little bit higher than the lowest lows we saw after that huge sell-off. The Fed futures are bearish. The odds of no change, those are those red histogram bars. That's for the June meeting, by the way. S&P 500 in blue. When it's expected that the Federal Reserve will not cut rates, these bars go up. But now we're seeing a 10% decline as of Friday. That's the change, by the way, between Thursday and Friday. And that shows us a 10% decline in the probability of no cut, meaning we're moving closer to a cut. Here's another way to look at it. In yellow, S&P 500. In blue, that's a probability of no change. And we can see very strong correlation. When the stock market's weak, the probability of no change declines. Conversely, when the stock market bounced, well, there was a bounce also in the probability the Fed would not cut rates. But it looks like we're back to the downside now. Now, in blue, that's a probability of a quarter point cut. In yellow, no change. In red, half a point cut. We're not expecting half a point cut. But notice what happened between Thursday and Friday of this past week. The odds of no change dropped from 34 to 24%. That's that 10% drop. But notice what took the place. We went from 58 to 63% chance of a quarter point cut. More importantly, we saw the probability of a half a point cut rise to 13%. Why is that important? We haven't seen a 13% probability or anything higher than that occur in the past 2 weeks. So we're now at 2-week highs in the anticipation the Fed will cut rates by a half a point. Still, it's only 13%. It's most likely not going to happen given current data, but we're moving in the wrong direction. Now, let's talk about the S&P ranking. What is that? Where is the stock in relation to its 52-week high and 52-week low? So here we have a stock, average stock, $16 a share. The 52-week high, the annual high is $20. The annual low is $10. So right now we have a ranking of 60%, meaning it's 16 out of a range of 10 to 20. Here's another way to look at it. If the stock was $20 in a range of 10 to 20, it would have a 100% ranking. 18 would be 80%, 16, 60, 14, 40, and 12, 20. Okay. If it was $10, we'd have a ranking of 0. So keep this in mind. Now we've taken the average of every single stock in the S&P 500, all 500 stocks. We've calculated their individual rankings according to their respective individual 52-week ranges. We've put it all together. That's what we see in red, in white, S&P 500. Notice in particular, right now, if you average all the stocks in the S&P 500 according to their annual range from low to high, we'd be at 45% right now. Put that in perspective. We were at 45% on March 14th, the day after that very big low that we established on the 13th, where we were at 40%. So essentially, if you take all the stocks in the S&P 500, these are the internals, and you try to figure out where they are in terms of 52-week highs and lows, we're just a couple points above the lowest point that we saw amongst the lows that established March 13th. And by the way, that 10% decline classified us in correction territory. So if we're happen to make new lows, it's going to tell us market internals are very weak. So what are the takeaways from all this? The economic data, it's just okay. We'd like to talk about good news. The durable goods was good, but we're rushing to the store ahead of the tariffs. The consumer sentiment is declining, and that really is important because you look at the PCE or the GDP, these are numbers that are calculated over months and even a quarter, but the consumer sentiment is us. Ultimately, when we go to the store, when we decide to make a large or small investment, it's the consumer sentiment that really drives that decision, and that's declining. We're at more than 2-year lows on that. So pessimism at the checkout counter can certainly lead to pessimism in the stock markets. The Fed futures are anticipating a rate cut. Now, maybe the economy needs it, but we see a very strong correlation. As we move closer to a rate cut in June, for example, well, the stock market is very closely correlated to that, and that doesn't bode well for stocks. And the stock market internals, that ranking between the 52-week lows and highs, they're weak. And we've spoken about this phenomenon in the past. You look at the bull market that we saw over the past couple of years. It was led primarily by those Mag 7s, NVIDIA, Amazon, Tesla, and the others. When the leaders of the market fall apart, which they have, You don't have leadership. It's the same phenomenon we saw in 2007 and also in 2000. So without a full recovery in the Googles and Metas and Teslas, where's the leadership in the market? Speaking of economic news, we don't get a break next week. On Tuesday, construction spending, ISM manufacturing, job openings. That's a JOLTS number. On Wednesday, ADP, that's another jobs number, and factory orders. And then, of course, Friday, that's the big number, the unemployment number, the non-farm payroll. Remember, last month's non-farm payroll number did not yet reflect all the layoffs coming from Washington and all the federal, jobs that have ended. So a lot of analysts are expecting a very weak number. And, even on the surface, if we understand why it's weak, that certainly is not going to bode well for consumer sentiment. We're going to be back with a lot more to talk about this week. We hope this has been helpful. We look forward to seeing you back soon.